Here in the United States, our 401ks tend to be a really important part of our retirement savings game plan. And because of that, a question I get asked as a financial advisor for over 20 years is, hey, Azul, should I max out my contribution to my 401k, or should I just put in the minimum to get the employer match? And so today I want to talk about the advantages and the disadvantages of maxing out your 401k contribution. And I want to begin with the end in mind. Let's say you're in your 40s or your 50s, and I want you to imagine you're now 65 years old, you're retired, and you're taking money out of your retirement savings account. If all of your money is in a traditional 401k, that money is going to be taxed as ordinary income. And so if all of your money is in this regular 401k, then every time you need to take money out, it's going to be taxable income to you. And so in my industry, the joke is, every time you fill your car up with gas or you go to the grocery store and buy a loaf of bread, you're paying for that with taxable income. And most of us don't want to be in that situation. So what do? Again, the contribution limits for people below 50 are $23,000 a year. If you're 50 or older, it's an additional $7,500 a year you can put in. And I think for most of us, we want to have money not just in a regular 401k or a regular IRA, but we want to have money in one of three different buckets. And those buckets are the traditional 401k, the traditional IRA, where our money is going to be taxed on the way out. We got the tax break on the way in. So I call that a tax me later account. So we want some money in the tax me later account. We also want some money in what I call a tax me never account. And that's the Roth version of the IRAs, the Roth version of the 401ks. And I call it a tax me never account. It really should be called a tax me today, but never tax me again account. And that is because we do not get the tax break on the way in. But then when we take money out to fund our living expenses in retirement, that is not taxable income. And then the final bucket is what I call a tax me as I go account. And that is like your money in a regular bank account where you get a 1099, you're paying tax on the interest or the dividends that you're receiving on that money each year. So those are the three buckets, but let's get back to the 401k and should you max out the 401k. The 401k has a lot of advantages to it, not just the tax deferral status, but the other is the employer match. So outside of having an emergency fund I call it emergency fund A and emergency fund B, the small emergency fund and then the fully saved emergency fund. So outside of a small emergency fund of maybe $5,000 or $10,000, then I think the next money people should put in is the 401k up until the match. I should mention none of this is financial advice for you. I just want to put on your radar screen these ideas for you to think about what's the right match for you. I don't know your situation, so I can't give you specific advice. But for a lot of folks, it's first set up an emergency fund where if you had a car repair, an unexpected car repair or a medical bill, you can pay for that without putting it on your credit card and paying 20+% interest. The next money is your 401k up until your employer match. And for many of us, we have the choice to do that in a regular 401k or a Roth version of the 401k. And then after that, you start diversifying your money and putting it in different places, which is the subject for another video. But the 401k has advantages in that you get that tax deferral day one. You're getting the tax advantage. You're taking those dollars that you're putting in to your 401k, you're taking that from what is likely going to be your highest incremental federal tax rate. Let's use an example. Let's say you do decide you want to max out your 401k, and let's say you're under 50, so you can put in $23,000. And let's say, just to give me easy math, you make $73,000 a year. So would have been taxable income at $73,000 a year. And you got to remember, you got to look at your standard deduction and things like that. But you're taking that $73,000, which some of those dollars are going to be at your higher tax bracket. The U.S. has 7 tax brackets, starting at 10%, then 12%, but then it jumps. And it jumps up to, I believe it's 22%, and then 24%. So there is no 13, 14% tax bracket. So it's a big jump. And so you're taking those dollars that might be at the 22 or 24% level, and you're getting it taxed at the much lower 10 or 12%. So that's a big advantage, is you're taking dollars off of the top of your income and what could be your highest income tax bracket at the federal level. But then when you're retired and you're taking money out, you start filling up first the 0% federal tax level, then the 10%, then the 12%. So think of it as you're taking money off of the top, but then from a tax standpoint, but then when you start withdrawing, you take it back out from the bottom. So that's the advantage of a regular 401k. Another advantage of any 401k is many employers allow you to take loans from your 401k. It's about 25% of all 401k participants take loans. Now, most financial advisors are going to share, do what you can to avoid trying to take a loan. And one thing I want to make sure that you're aware of is most plans are going to require that you pay back that loan in full if you ever leave that company for whatever reason. If you're laid off or if you're fired from that position, you have to pay back that loan. And if you don't, it's going to count as a distribution from that account, which is definitely going to incur federal income tax and might incur the penalty, the 10% penalty as well. So you want to be careful with that. You also want to be careful with the company's match. Many companies, if you put in 2% of your salary, they'll match 2% or 6% or 10%, whatever the number is. But it's very common for the employer contribution to have a vesting schedule. If you leave that company in the first, it depends on the company, in the first 2 years, you might get none of the employer's match. Many companies, what I've seen is the first 11 months, you get none of their match. And then on the 12th month, after that 12th month, you get 1/4 of the match. And then essentially you get 25% a year until you've been there for a full 4 years. And then you're fully vested. It's important for you to know that your money is fully vested day one in the 401k. So your money is always your money, the money that you put in. This is just for the employer. So I talked about loans, I talked about the employer match, and then I also want to talk about one of the negatives of a 401k, which is it can be difficult to get that money before you're 59 and a half, or I should say it can be expensive. You have the option of a loan, and you should also know there's 2 tools that I'm going to mention that I want you to look up yourself that allows you to access your money before you're 59 and a half. I mentioned earlier, none of this is financial advice. Nothing I'm sharing is tax advice, but I do want you to know about the rule of 55 and 72T, which is substantially equal payments. But I want you to look that up and read about it. Be sure to look at the IRS website. There'll be some great documentation on the internet about both of those, but essentially these are tools that if you needed to access your money before 59 and a half, these are tools that the IRS allows people to use and avoid that penalty, the 10% penalty. So look it up, Rule of 55 and also the 72T. Now, we've been talking a lot about traditional 401ks, but what about a Roth 401k? Where I mentioned earlier that with a traditional 401k, you're taking dollars that you're putting into the 401k, and those are really coming off of the top of your tax brackets. Where with the Roth 401k, you're paying the tax on the money first, so you're not putting money in pre-tax dollars. You're putting money in after tax, so you're still paying that tax. The advantage of that is after it grows and when you retire, then you're taking money out, and that does not get triggered as taxable income. So the way the current tax law is written, and hopefully it doesn't change, you never pay federal income tax on that money once it's in a Roth 401k. So that can be an advantage. And what I like to tell clients is, my grandfather was a farmer. Would you rather pay tax on the seed or the harvest? Right? With a regular 401k, you're paying tax on the harvest. And with a Roth 401k, you're paying tax on the seed, but then you don't pay tax on the harvest, which makes it seem like, boy, it's always better to have a Roth 401k, but that's not the case. In fact, if the tax rate is the same between when you put money in and when you're taking it out, if you're paying at the same tax rate, you're basically indifferent between a Roth and a 401k from a tax standpoint. Let me give you an example. Let's say that you have $5,000 and you're putting it in your 401k, in a regular 401k. So in this case, you don't pay any tax on that $5,000. So you put the full $5,000 in. Let's say that 10 years later, that money has doubled and you're now 60 and you're taking money out. And let's say you're paying the 20% tax rate. So now you have $10,000, but you got to pay $2,000 to the federal government. So you have $8,000 left, right? So that's the traditional. Remember, you have $8,000 to spend in retirement. Now let's say you did a Roth 401k. So in this case, you had $5,000 to invest, but you had to give the government 20% of that because it's taxable. So you only put $4,000 in your Roth 401k. 10 years later, it doubles. You have $8,000, but you don't have to pay any tax on it. So you get to spend $8,000. Those numbers are the same. So that is really, if the tax rate is the same on both sides, when you put the money in and you take the money out, you're indifferent. So how do you decide whether you should max out your 401k? Again, I think you begin with the end in mind. What do you want your retirement to look like? And if you have all of your money in a Roth 401k, you'll never have to pay federal tax on that. If you have all of your money in a regular 401k, then every time you fill up your car with gas, you're paying taxable income on that money that you're withdrawing to do that. So I don't think either of those make sense from optimizing a tax standpoint. For most people, you want to have the three buckets. You want to have a regular 401k so that you can take advantage of, there's 7 tax brackets in the United States. You can fill up the lower tax brackets, which are 10% and 12%. And frankly, there's a 0% tax bracket in the United States too, because we get to take our standard deduction. So some of the money that we take out is going to be income tax free. So I think for many people, thinking about having 3 buckets makes sense. You have your regular 401k, so you can fill up those lower tax brackets in retirement. You have your Roth 401k, so you have income tax-free money coming out. And then you have your regular 401k. So does it make sense to max out your 401k? It's a complicated question. Does it make sense to save that money in a retirement account as opposed to going out and buying something that might not bring you joy? For me, that's a values question, and it's your money. Spend it how you want. This is not a values decision. But I think most of us, we want to balance it. We want to enjoy the journey while also having a healthy retirement. So thinking about that balance. So I hope this video has been helpful. If it has been, I think you might find this video up here where I talk about what does the average retiree in the United States have in income. I think you'll find it fascinating, and I'll see you in that video. Thanks for watching this one. Bye-bye.